So I'm going to ask you this. Is the market bottom in?
Well, I think the likelihood of a retest of the June lows or making new lows has gone lower in the last few weeks. And that's because market internals have improved. So what I mean by market internals is things like momentum and breadth. So the number of names that are participating in the rally. And what was missing from the rallies that we had earlier this year was that they were really anemic. There was no momentum and there was no breadth, meaning that they were just led by a few handful of names. But that's different this time around. We've seen indicators like the number of names trading above their 20-day moving average surge to levels that are usually consistent with good forward returns. So that's why we think that even though we could be susceptible to a shock or some kind of liquidity event, that because we've seen this improvement underneath the surface of the market, it reduces the likelihood of a retest.
But as we said earlier in the show with Dom Chu, I will remind our viewers, and who knows where we'll go, maybe we rocket higher another 40% or we turn back down, Cameron, that some of the best market runs come in the worst markets. In other words, you can have violent bear market rallies like in the 70s where the market doubled only to fall back again. I would imagine you would advise your clients, and I don't want to put words in your mouth, but don't get too giddy. Be careful, be cautious, stay vigilant.
Yeah, that's such an important point because it really is about the discipline of not chasing these rallies. We don't want to be buying into this strength. We'd rather be buying into weakness. And we think that the challenge for the market here is that valuation really acts as a ceiling on this market. We're trading at about 18.5 times next 12 months earnings, and we struggle to see how that could sustainably move much higher. There's really only 3 reasons why you should pay a lot more than 20 times for earnings. The first one is that if earnings estimates have been cut so much that you're willing to pay a high multiple because you expect them to rally in the future. The other one is if the Fed is flooding the market with liquidity. That's certainly not what they're doing yet in this tightening cycle. And the last one is if you're in a bubble, because in bubbles, valuations go high and stay high. But you know what comes on the other side of the bubble is usually a crash. And so we don't think that we have any of those 3 characteristics right now, which means that valuation is a ceiling.
And we got to get a squawk pick. I don't want to mislead our viewers. I put that in the intro. There's a lot of stuff in this big Senate spending bill that's good for oil and gas. The oil and gas industry likes it. You like EOG.
Yeah, within a cyclical sector like oil and gas, you have to play with the best-in-class players. And we saw that in last week's earnings from EOG, where they had very strong growth in their earnings, but they didn't have to raise CapEx. So a lot of the other E&Ps or exploration and production companies are having to raise CapEx quite materially in order to increase output. But because EOG is able to do more with less, they're not having to do that. And that allowed them to fund a $1.50 a share special dividend. And so even though there's a lot of uncertainty about oil prices, we've seen them be weaker as there's been questions about growth, having a name like EOG, which has a very strong balance sheet, 0.14 times of debt, that really indicates that we can ride out these cycles and buy into weakness because they really are the best in class player.